I've mainly been looking at stock indices so far, since I think that there's a potential for a big fall, and in fact we have had a decent fall already. Let's get this down here. Now there are various rules that we use when we're working with indices. For example, we saw the importance of the 200-day moving average, how that basically splits whether you're in a bull or a bear market. The indices are moving around randomly, but if you overlay moving averages, they do provide some structure. You can kind of see, oh, actually, yes, this is falling, but when it's jumping up, it seems to bounce off maybe the 50-day moving average or the 20. So we can then incorporate that into our trading. We kind of go, okay, I'll wait till it goes near the 50, or it's in between the 20 and 50, then I'll short it. I'll put a stop loss above the 50 and then let it keep falling, maybe till it hits the bottom of the Bollinger Band, those things. So that's the kind of thing we've been doing so far. For different markets though, shock surprise, it's different. So I'm primarily familiar with shares, but I also had my go at currencies. So this is a chart of the euro against the US dollar, which is the most traded thing. They're the top two currencies. So yeah, there's a massive, stunning amount of trade between them. So how's this different? Well, I'll overlay the indicators that we're familiar with. So a couple of moving averages and the Bollinger Bands. So I've got the 9. Well, I'd like to have maybe the 50, the 100, and I'll do the 200. Okay, and this is a short period of time, so I'll zoom back. Well, does it look particularly different actually? That it seemed actually for the euro dollar, the chart's quite similar to the DAX, when we're looking at those indices, that you've got the 200-day there, the market seemed above it. When it touches it, it bounces back up. When it touches it, it bounces back up. And when it broke, it started a big fall. So actually, the standard indicators, methods, don't seem hugely different. Now, the point I wanted to make, and this actually I hadn't expected the charts to be so similar, is that, well, at the end of the day, currencies tend to be nearly mean reverting. So if you have, say, the sterling dollar, that you'll have periods where one will get a lot stronger. So remember, say 2007-8, when the crash began, the dollar devalued a lot. And so, with QE and the rest, or you basically had the dollar falling by maybe 20-30%, as in it being 20-30% higher than it should be, maybe using purchasing price parity and those kind of ideas. What that means is that the US does very well. If you're a business in America and the dollar devalues by 20%, then it's going to be far easier to get business. Well, because suddenly there's a 20% off sale. You're paying your workers, your staff, the same wages, but to people abroad, it's 20% cheaper. And in fact, I remember flying over to the States and buying all kinds of stuff because it was so cheap. In the same way now, where the euro's fallen a lot, it's great for American tourists. They can come over and everything is very cheap. So what happens is, if your currency is devalued, it's a big boost typically to your businesses. Of course, the price of oil shoots up because your dollar has or your currency has fallen, so the price of other things go up. Unfortunately, the dollar is a bad example because, of course, oil is priced in dollars, but that's another thing. So the point was that with the stock market, there's an undeniable upward trend, which is not the case for currencies. The currencies, it's harder to it's harder that way. That said, if an area has got high inflation, then the currency will tend to devalue. So there are only a handful of factors. You'd look at what is the interest rate in the country. So if you get more interest from a country, you want to own that currency because you're able to get that interest rate. Famously leading to the carry trade, which is a phenomena associated with currencies. So there, what you do is you borrow in a currency which has a very low interest rate, and then use that money to buy a currency which gives you a high interest rate. So from about 2000, Japan was having troubles, so the interest rate basically fell to zero, which was fantastic for financial institutions, who then borrowed vast sums of money in yen and used it to buy the New Zealand and Aussie dollar, because they were paying 5, 6, even 7%. So, if you borrowed, I borrow 100 billion, and now I'm getting paid, I don't have to pay any interest, and I'm getting paid 7 billion a year for doing nothing. So jump on. This was done on a massive scale. Now imagine if billions and billions, hundreds of billions of yen are being used to buy, say, the Aussie dollar. Supply and demand. What's going to happen? That process drove the value of the yen down, and it drove the Aussie dollar up, which was even better. So think about it. Imagine you borrowed, say, 1,000,000 yen, and you're paying no interest, maybe 0.5. With that, you've put that in, and you've bought Aussie dollars. So now you're getting paid 7% a year, maybe 6.5%, because you are having to pay 0.5%. But to your surprise, after 2 years, the yen halves in value. So now, if you convert, your Aussie dollar pot, which is making near 7%, you only have to pay back half the amount that you borrowed, because you used your yen to buy the Aussie dollar, which doubled in value. So now you could say, take half your money and pay off all the debt, pay off your loan. So now you're sitting on half the money you borrowed, free cash. So that's a phenomena that happens with currencies. At the moment, the euro dollar, or the euro, has fallen a lot, and the interest rate is actually, I think, it's 0.5%. There's a chance that, well, why not use the euro as your funding currency for a carry trade? If you can find an area which is paying you high interest, it's worth a go, perhaps. I'm going to see whether I can get the Aussie dollar yen. It's probably not that. Okay, so it's the AUD JPY. After a bit of messing around. So can't so much see it on the daily chart. So I'll just jump to monthly. Now you can see it. So let's zoom back a little. So look at how violent these moves are. So this is the period that I was talking about. So the Aussie dollar, the interest rate in Japan is near zero. China is booming, and Australia is known as a commodity currency because they have gold and various commodities. So when commodities shoot up, it's very good for them. So interest rates are going up in Australia because at this period, because things are good. So if you'd bought Australian dollars with yen, it would have cost you 56. But as more and more people were buying it, the Aussie dollar shot up and up and up. So as I said, at this stage, you double your money just on the currency, even if you weren't being paid any interest. So, it seems like a too good to be true setup. But the carry trades are very sensitive to risk. So essentially, as this is going up, you have loads and loads of people highly leveraged betting on this and having a great time. But when it starts breaking, so you have people maybe like who just jumped on this when the level was 95. You know, they didn't all buy it just at the bottom, because you don't know when it's going to stop. It could double again. It's like house prices. You know, you hear, oh, if I'd followed your advice, I wouldn't have bought 10 houses last year and made $1 million. And people keep using that same logic, so that when the top of the bubble is reached, they now own 1 million houses and they expect to, you know, make an absolute fortune. Same kind of process. So these guys are all leveraged, and now as it starts falling, they're going, what? And they can't pay. They're having to make margin calls. They can't, so they are desperately shutting down their orders, which means that suddenly you have all these orders of people buying yen with Australian dollars, which starts reversing the momentum. Suddenly the value of the Australian dollar is falling, and so that's it. There's positive feedback. It just feeds on itself. To some extent, this might have been happening because, say, the price of commodities start falling. That could have driven the value of the Aussie dollar down. If the interest rates start falling, then that would drive the Australian dollar down. So suddenly enough reasons appear on the other side of the argument, and the bubble bursts. Now, if you had shorted this, just imagine, you would have made an absolute fortune, because this is currencies, so it's very highly leveraged. So another style of trading might be to go, I will look at carry trades and try and pick the bottom. And just as a algorithmic trader kind of guy, since we saw in the other video or other part when I was looking at Eurodollar, that actually the 200-day moving average was handy enough. So, well, oh sorry, this is the month. So I'll pick another number. So even, yeah, this is a month. 200 months is a long time. I'll try 1,000. So that's how you do it, and you know, trial and error, and see whether that looks like a. I suppose 1,000's too big. I don't have that much data, perhaps. Okay, so this is the blue line is a 20-month, and I'll do 50 here. Okay, because by using a longer time average, you smoothen out, you know, the noise of the little up and down movements. You're trying to capture the big trend. So, okay, how would this have done? If I use the 50-month moving average, Well, when it broke that, it fell a lot. So I might have sold at this point. And in fact, now it's broken through that again. And when it tried to go up, it just touched that and fell. I don't know whether this 50-month is a very significant, whether that's the right number to use. But that's for another day. But you can see that basic mechanic of the carry trades. It's like your boom share, the share that the hot share in a bubble. It's going up, 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 and everyone goes, this is fantastic. And then, of course, the bubble does burst. Finally, you also have commodity currencies. Well, not commodities. So you have gold and oil as the main ones. But of course, you also now, I would say, soybeans, silver, platinum, they're all traded. But I've gone on longer than I'd expected already. But what I wanted to mention was just that the different commodities, different classes of things are different. Though I was surprised to see that it wasn't that different. What I'm going to do next is look at the next layer in currencies, equities, commodities. So what I mean by that is I talked a little bit about the carry trade here, but there are other classes there are 2 or 3 main groups when we're talking about currencies, and likewise there are 2 or 3 different groups of shares. So we'll look at those in the upcoming weeks so that you have your basic frameworks. Remember to subscribe so that you'll get updated as these lessons are posted. Good luck.